Hello everyone, and welcome back to the channel. Today, we're taking a deep dive into the future, specifically into the first quarter of 2026. What can we expect from the US stock market? The headline for the quarter is Momentum with Caution. We're likely to see gains, but it's going to be a bumpy ride with a lot of volatility. So, stick with me as we unpack the key drivers, the most likely scenarios, and the sectors that could lead or lag. Let's start with the big picture, the macro environment. The story really begins with the Federal Reserve. After a period of tightening through 2024 and 2025, the Fed has shifted gears. Recent rate cuts have created a friendlier backdrop for stocks. Markets are now pricing in an environment where policy is no longer a headwind. Senior Fed officials have been clear. They want to bring inflation down to their 2% target, but they don't want to derail economic growth in the process. This is a significant tailwind for equities. Why? Because lower interest rates increase the present value of future corporate profits. This is especially good news for growth-oriented companies. Now, what about inflation and growth? Inflation has definitely cooled from the highs we saw a few years back, but it's still hovering a bit above that 2% target. The general consensus, both from economists and the Fed itself, is that we'll see further moderation through 2026. At the same time, economic growth is expected to remain positive, albeit at a slower pace. We're talking low to mid single-digit GDP growth. This soft landing scenario, where inflation slows without triggering a recession, is the base case as we head into the quarter, and it's a supportive one for stocks. But the margin for error is slim. The third piece of this macro puzzle is earnings. This is where the rubber meets the road. Analyst projections for S&P 500 earnings growth in early 2026 are looking pretty strong. What's driving this optimism? Better cost controls, some continued pricing power, and most importantly, the tangible benefits of technology and AI adoption, which are boosting both productivity and revenue. If companies can actually deliver on these high expectations, the market should rally. But if they fall short, the disappointment could be severe, especially given where valuations are today. So, with that backdrop, what's the most likely path for the market? Our basic casi, with about a 55% probability, is for modest to solid gains in the major indices like the S&P 500 and the Nasdaq. The gains will likely be concentrated in specific areas: technology, companies enabling the AI revolution, and high-quality cyclical stocks. We expect to see momentum early in the quarter, thanks to positive seasonal trends and the Fed's easier stance. But don't expect a straight line up. We anticipate elevated volatility with periodic pullbacks of around 3 to 7%. These dips will likely be seen as buying opportunities by institutional investors. Of course, we have to consider other possibilities. Let's talk about the bull case, which we'd put at around a 20% probability. In this scenario, corporate earnings don't just meet expectations. They blow them out of the water. Imagine a surprise acceleration in how companies are monetizing AI, coupled with a surge in stock buybacks. If inflation also cools faster than expected, you'd have the perfect recipe for a sharp, broad-based rally. We could see new leadership from sectors like enterprise software, semiconductors, and industrial tech. Some of the more optimistic strategists are already pointing to this scenario for their high year-end price targets. Then there's the bear case, which we can't ignore, with about a 25% probability. What could trigger a downturn? It could be a data shock, like a sudden re-acceleration in inflation that makes the market doubt future rate cuts. Or it could be a geopolitical crisis or a credit event that spooks investors. In this scenario, we could see a meaningful correction, perhaps a drawdown of 10% or more, likely hitting the most expensive growth stocks the hardest. Even if the headline economy looks okay, the risks of a late cycle slowdown are real, and this is a plausible outcome. So, where should investors be looking? Let's break down this sector outlook. The likely winners in the first quarter of 2026 are pretty clear. First up, AI and enterprise technology. The market will reward companies that can show they're actually making money from AI, not just talking about it. This includes software vendors, certain semiconductor firms, and companies leading the charge in cloud adoption. The narrative that AI is a multi-year earnings driver is very strong. Next, look for cyclicals with pricing power. These are companies in sectors like industrials, select materials, and capital goods. If they have strong order books and can translate that into near-term earnings growth, they should do well. Finally, keep an eye on financials, particularly certain banks and fintech companies. If the interest rate environment stabilizes and credit conditions remain healthy, these firms can benefit from better loan growth and fee income. On the flip side, who might lag? Low quality, highly leveraged small-cap stocks are vulnerable, especially if economic growth slows more than expected. They are the most exposed to any tightening of credit. Also, be wary of the overhyped momentum names the stocks that are priced for perfection. If they stumble even slightly on execution, or if interest rates stop falling, they could underperform significantly. In terms of style, this will be a market where quality and earnings growth matter more than just pure price momentum. Investors will favor companies with high returns on equity and strong, consistent cash flow. Now, for some of the nitty-gritty market mechanics you should be watching. First, the yield curve, specifically the spread between the 10-year and 2-year Treasury yields. A steepening curve, where long-term rates are higher than short-term rates, is historically good for cyclicals and financials and signals economic health. A continued inversion, however, increases recession fears and favors defensive stocks. This is a key indicator to monitor daily. Second, pay close attention to the Fed's communication. Any hint that they are shifting from their accommodative stance back toward a more hawkish tone would hit growth stocks hard. Watch the FOMC minutes and any speeches from key Fed officials very carefully. And third, earnings season itself. The reports for the end of 2025 and the guidance companies give for Q1 2026 will be crucial. Upgrades to earnings estimates are often the most direct fuel for a market rally. Of course, no forecast is complete without discussing the risks that could completely change the picture. A sudden inflation shock, driven by stubborn services inflation or a spike in energy prices, is a major risk. A geopolitical flare-up, disrupting trade and supply chains, is another. We also have to be mindful of a potential credit event, like stress in the banking sector, or a simple case of widespread earnings misses that force investors to reevaluate what they're willing to pay for stocks. And finally, a policy surprise from the Fed moving faster or slower than the market expects could also cause a major disruption. So let's bring it all together. What's the practical, actionable takeaway from all of this? The first quarter of 2026 is shaping up to be a period that rewards strong corporate execution against a more favorable monetary policy backdrop. But it won't be an easy ride. Expect positive returns on average, but be prepared for sharper than normal volatility. The market's winners will be the companies that can turn their investments in AI into real revenue or that can maintain their pricing power as inflation moderates. For investors, this means risk management is paramount. Focus on quality companies, stay diversified, and monitor inflation data, Fed communications, and corporate guidance in real time. This careful approach will be the key difference between capturing the upside potential and getting caught in the inevitable drawdowns. It's a market for the nimble and the informed. Thank you so much for watching. I hope this deep dive into Q1 2026 was helpful for you. If you found this valuable, please hit that like button and be sure to subscribe so you don't miss our future updates. As always, let me know your thoughts in the comments below. See you in the next video.